Okay, we're beginning the module for monetary policy. Our first two learning objectives. First one is a describe. Second one is a describe as well. First one is roles and objectives of central banks. The second thing we're describing is multiple here, tools and the transmission mechanism. Tools used to implement monetary policy and the transmission mechanism. And relationships between monetary policy and economic growth, inflation, interest, and exchange rates. Okay, let's begin with the roles of central banks, and I've got them all in white. There are 6 bullet points here. 7 bullet points, and what is in blue is just extra narration around each point. Sole supplier of the domestic currency, and currencies are referred to as fiat currencies. Whenever you hear the term fiat, it means that that currency has its value by government decree. It is not convertible into any commodity. It used to be gold, sometimes silver, that every note in circulation was backed by a certain quantity of gold or silver. That's no longer the case. It derives its value through government decree. It acts as a medium of exchange as long as it holds its value, and this is important. Therefore, confidence in the currency is critical. It is the banker to the government. It is the banker's bank, usually referred to as the lender of last resort. So let's just draw out 4 banks here. These squares are banks. And if a bank needs money, it can always go to another bank and borrow money. And they can lend money to other banks. This is called the interbank market. Now, let's say that this bank over here starts having trouble such that these other banks say, we don't want to do business with you. But this bank needs money. Because customer deposits are leaving and it has to cover them. It needs money. It has no place to go. It can always go to the central bank. When it has no place left to go and it needs money, it can always go to the central bank. That is the lender of last resort. The central bank stands ready to provide funds, referred to as liquidity. Funds to any of the banks under its jurisdiction. Central bank is the regulator or supervisor of the payment system. It is the banking system supervisor, and it manages the country's foreign currency reserves and gold reserves. And the big one here, it conducts monetary policy. And monetary policy are the activities undertaken that influence the quantity of money and credit in an economy. Okay, objectives of central banks. There are 3 of them listed here. And while all central banks have these as objectives, they don't always have them as their primary mandate. So, for example, the ECB's primary mandate is to promote price stability, whereas the Fed has what's called a dual mandate, promote full employment and promote price stability. So they conduct monetary policy with those 2 mandates in mind, whereas the ECB conducts monetary policy with just price stability in mind. However, they all have these as objectives of what they do. It's just that they'll use monetary policy for 1 or 2 of these objectives. They're called mandates. So, maintain the stability of the financial system, promote full employment, and to promote price stability, which is the most common mandate. And the way they get this done, let's look at the tools. Open market operations. This is the purchase and sale of government bonds from and to commercial banks and other designated market makers. So, if we think of a bank, it has assets and liabilities. And some of its assets may be government bonds. And it may need a source of funding, overnight source of funding, because it had, over the course of the day, deposits come in and deposits leave, but the deposits leaving were greater than deposits coming in, which may rebalance itself tomorrow with the regular course of deposits coming in and out, so they'll borrow money for one night. Well, they can pledge their government bond to the central bank, and the central bank will then have some rate of interest at which they will pay. When they do this, when a bank gives their government bond to the central bank and the central bank puts money into the banking system, it is increasing the amount of money in the banking system, and when it goes the opposite way, it is decreasing. So the purchase and sale of government bonds, this can be overnight to 2 weeks. They're called repurchase agreements and reverse purchase agreements. And these are secured loans because the bank gives the central bank a government bond. The central bank then forwards the bank funds based on the value of that government bond. And the bank, when it gives them the government bond, agrees to come back the next day and buy it back. That's why it's called a repurchase agreement. The central bank will buy a government bond from a bank and then sell it back the next day at a slightly higher price. That slightly higher price is the cost to the bank of getting that loan. And it is that overnight cost that then sets the cost to the bank for providing credit to other customers of the bank. And a reverse repo is the opposite way, where the central bank will sell a bank a government bond and then buy it back the next day. This is when you have a bank with a lot of cash on its balance sheet that it has no place for it to hide. All the banks are in cash surplus, so what it will do is the cash will go to the central bank and a government bond will show up for one night, and then the central bank comes back the next day, buys back the government bonds, and replaces the cash with a little bit more. So it earns interest on that. The policy rate, also called the federal funds rate in the U.S., and whenever a central bank has a rate, there's usually a range. For example, Canada has a policy rate of, let's say it's 3%, and then there is 25 basis points higher and 25 basis points lower is the range. This is called the bank rate. This is called the target rate. That's called the overnight rate in Canada. In the U.S., there is an upper and a lower bound. The upper bound is the rate at which the central bank is willing to lend money to other banks in the banking system at, and the lower bound is the rate at which they're willing to borrow from other banks. So let's say they set a target range of 4.75 to 4.5%, and they're willing to lend money at 4.75%, and you have a whole bunch of banks out here. This is the interbank system out here. And this bank here needs to borrow money. Well, these other banks are willing to lend money. That's what they're in business for. They have no reason to lend for more than 4.75 because if all these lending rates are over 4.75, this bank can just go to the central bank and borrow for 4.75. So if any of these banks attempt to charge more than 4.75, they won't get any business. And they need to park their cash somewhere overnight because, well, they're there to maximize their return on the amount of assets they have. And what's the point of sitting on cash overnight? Also, this is the central bank is willing to borrow at 4.5. So let's say this bank has an excess of cash. It doesn't need to borrow cash. It has an excess of cash. And it goes to all these banks saying, what are you willing to give me if I give you cash overnight? And they're all quoting less than 4.5%. Well, they can go to the central bank and get 4.5%. Because of this, all of these other banks know that they would not charge more than 4.75 to lend or more than 4.5 to borrow, because if they do, they're out of business. Well, not out of business, but they're not going to do anything with their cash that night. And that is how the central bank makes sure that interest rates stay within a particular range, especially at the overnight range, by being the person that steps in and says, don't even try to borrow for less than this and don't even try to lend for more than that. A hike in the policy rate is meant to increase lending rates and constrict credit growth because the bank's cost of funds is whatever this range happens to be. So let's say you go into the middle of the range, 4.625, and just say, well, okay, on average, that's the cost of funds. If that's what it costs the bank to obtain short-term funds, well, then all its loans must be based off of at least that level and higher, right? And finally, we have the reserve requirement. We'll jump right to this point here. It's not used very much in developed economies. The G7 economies don't really play too much with the reserve requirement. It's more common in emerging economies. The reserve requirement is how much each bank of all of their deposits must keep at the central bank. So let's take a bank that gets a deposit of $10 from a customer. With fractional reserve banking, let's say the reserve requirement is 10%. That means $1 must be held at the central bank, and they can lend 9 out in terms of loans. This customer then buys some equipment for $9, and there's another bank that then gets $9 in because this person spent $9. The supplier of the equipment deposits in their account. Well, 90 cents must be held at the central bank, and that means $8.20 can be lent out. So because it can continue on and on, we can say that it's 1 over whatever the reserve requirement is, 0.10 equals 10. That means every dollar of deposits can create up to $10 in loans throughout the banking system. So if you want to increase the supply of money, you can lower the reserve requirement. So let's say you lowered it to 5%. 1 divided by 0.05 would equal 20. That means every dollar deposited can create up to $20 in loans because of fractional reserve banking. And if you want to decrease the supply of money, you would have a higher reserve requirement. Let's look at our transmission mechanism. Here is the official rate. How does the official rate affect inflation? How does it affect, how does it find its way through all that? There's the exchange rate here. There's inflation. Here are different prices. Here's total demand. Well, if you change the official target rate, if you have a yield curve that looks like this, there's the 1 month rate. Typically, you have an upward sloping yield curve, such that there's the 10-year, there's the 20-year, the 30-year, the 5-year, the 2-year, the 3-month. If you raise the target rate, well, it raises the short end of the curve. The short end of the curve starts doing this, and the higher you go, the flatter the curve becomes, because long rates don't go up as much, but they do go up. So if you increase the target rate, what you're doing is you're increasing market rates. If you're increasing market rates, you make credit more expensive. And if you make credit more expensive, at the margin, some people will say, oh, the loan is too expensive. I'm not going to finance this. I'm not going to get a new mortgage just yet. So it does reduce the amount of credit in the system. It will affect asset prices, because the higher the official rate goes, the higher the yield curve goes. These are all risk-free rates. They form the basis of discount rates, the rates at which you would discount future cash flows. So if your discount rate is increasing, the present value of future cash flows decreases. Well, that is the price of bonds. That is the price of equities. We use a discounted cash flow to arrive at the price. Expectations and confidence. So if inflation is high and the central bank is raising rates, and we have confidence that the central bank will do its job, that it can actually influence inflation, then higher levels of inflation will not be built into expectations. That's an important thing, to make sure that inflation does not find its way into expectations, because as soon as it does, then prices will go up, only because individuals and firms would expect prices to go up, and then it becomes self-fulfilling, which means you've really got to crush the economy to get expectations of future price increases out. And of course the exchange rate, because the higher the interest rate, the higher the value of the currency. Because if the interest rate goes up, then government bonds start paying a higher return. Money, capital flows will flow into the country to take advantage of the higher returns on these government bonds. And since money is coming into the country, it must buy the domestic currency, which tends to push up the value of the currency. If you have the currency going up, look what's going on over here. Import prices. Well, suddenly it becomes cheap or cheaper to buy goods from other countries, as long as the prices of those goods are not increasing. So if we were buying avocados from Mexico and the US dollar kept getting stronger and stronger and stronger, well, avocados would get cheaper and cheaper and cheaper in US dollars, even though they're not changing in terms of Mexican pesos. And of course, it works the other way. When interest rates are going down, the currency value drops and import prices rise, because a US dollar that's dropping and dropping and dropping, avocados would become more and more and more expensive in US dollars, even though they're not increasing in pesos. So if you are removing the desire for credit, or making credit more expensive in the economy, you will affect domestic demand. And you will affect net external demand as well, because if your currency is increasing, even though it's you internally get cheaper prices from abroad, Mexico would find it very expensive to buy items from the US at that point. So it will affect total demand. It will decrease total demand as you're raising interest rates. That would lower inflationary pressure and then lower inflation. Next, learning objective, describe qualities of effective central banks. Contrast their use of inflation, interest rate, and exchange rate targeting. So it's inflation targeting, interest rate targeting, and exchange rate targeting. Contrast their use of these in expansionary or contractionary monetary policy, and describe the limitations of monetary policy. Okay, let's begin with inflation targeting. And this gained prominence during the 1990s in New Zealand. And they targeted a range of 0 to 2%. So what inflation targeting involves is to target a specific range of inflation and to make it public. It's no good if you keep it quiet. It's like a nuclear weapon. There's no point in keeping that a secret because it's a deterrence weapon, right? Well, this is what a inflation target is. It's a deterrence. It's a deterrence to expectations. You don't want inflation expectations to get built into prices. You want actual inflation to be reflected in prices, but not the expectation of something that hasn't happened yet, only your belief that it will happen. So you want that to disappear. If you have a credible central bank and the central bank has a target, expectations will fall in line with that target and say, well, it won't be 4%. The central bank won't let it happen. That's the point of it. Make it public so it finds its way into expectations, so it becomes self-fulfilling. If we believe the central bank's target of 2%, and we're setting our prices for next year, and we have a certain formula by which we raise our prices in line with the general level of inflation, then we will use 2% as our input and not, we think inflation will be 6%. We will believe the central bank is credible and will use their inflation target. 2% is the most common. There is a conversation whether or not, why not 3%? Why not 4%? And to answer that, we can sort of just eliminate some possibilities. 0%, probably not a desirable target. May result in deflation because it's too close to zero, and we don't want deflation because you do get bad outcomes, especially for debt. If you have higher targets, you'll have higher inflation volatility. There are lots of variables in finance that have what is referred to as rate-dependent volatility or level-dependent volatility. Interest rates are like this. The higher interest rates are, the more volatile they are. The lower they are, the less volatile they are. Inflation is the same way. So if you set a higher inflation target, you have to live with higher inflation volatility. That might work against expectations, and that might work against stable prices. So higher targets, higher inflation volatility is not consistent with price stability. For an inflation target to work, as I said, you need credibility from the central bank. So we're going to identify here 3 elements that are important or required around a central bank for an inflation target to be credible. Central bank independence, and that's independence from government. That means that they can make decisions without government approval. They can say, well, we're going to raise interest rates without it having to go to a vote on the floor. They can just go ahead and make that decision on their own. The members of the central bank, the voting members, and the head of the central bank, nonpartisan, non-elected, therefore they will not use monetary policy to get reelected. Let's assume that they weren't independent and there's an election coming up and unemployment is simply too high. There might be pressure from the government in power to tell the central bank to lower interest rates to spur on the economy. But what if inflation is 8%? They might not have the political will to say, okay, well, we have to suffer high unemployment because inflation hurts everyone. They may just sacrifice inflation for low unemployment because it's very difficult to get reelected when unemployment is high. Typically, the party in power gets blamed for the economy. So that's why you want an independent central bank, because you don't want the idiots in government having anything to do with what smart people should be doing, right? 2 types of independence. You have operational versus target independence. Operational independence means they can change interest rates. They can change reserve requirements without having it go to a vote on the floor. Target independence means they can actually set an inflation target without it actually being voted on as well. So they can set the inflation target and whatever definition of inflation they use and the horizon over which is to be achieved. So, for example, the U.S. Central Bank targets PCE, not CPI. The personal consumption expenditure targets 2% headline over the long term. Number 2, credibility. The market must believe that the central bank will stick to its targets, and we can always measure how much the market thinks the central bank is credible by looking at inflation expectations. Here we can find them in break-even rates. So we can look at yields on, let's say, a 5-year U.S. Treasury, versus yields on a 5-year TIPS. The difference between the yield on the Treasury and the yield on the TIPS would be the inflation expectation, because it's a nominal yield minus a real yield, and that should be well anchored around 2%. So we can just look at all the range of TIPS and just compare the break-even rates, and the break-even rates would be the inflation expectation built in. Transparency. The minutes of the meetings, press conferences, economic forecasts. For example, the Fed produces something called the SEP, the Summary of Economic Projections. It does this every second central bank meeting. And when we're looking at the minutes of the meeting, we should see that the Fed or the central bank considers a wide range of economic and financial market indicators. Some exceptions to inflation targeting. Bank of Japan. They have no explicit measure of inflation that they target. They're more concerned about deflation, and that's because of their demographics. They are an old population and getting older. The cohort at the top, if we look at their, let's say this is 0 to 10 years, to 10 to 20 years, 20 to 30 years, 30 to 40, they have a population that looks like this, where you have like 60 and older, where it is a big cohort up here and a small cohort down here. Well, usually you have, if you think about lifestyle spending, it looks like this, and then starts to decrease. And this is about age of 45, that we increase our spending to about age 45, where we hit peak spending, and then it declines from there. Because at that point, the furniture is being bought for the house is being bought, you're just paying it off, your material needs start to decrease, and it is believed that the kids have left the house by the time you're 45, because assuming the average age of kids is 25, when you're 45, they're 20, and they're heading off to school or university, so that the average household spending decreases at 45. Well, when you have a very old population, they're down here on their spending, which produces deflation because there's not enough demand in the economy for the supply. So they've been promoting inflation going on 20, 30 some years now, since the early 1990s. So they don't even have a measure of inflation, and it may not even be credible even if it did announce a target, because it has been fighting deflations for so very long. Another one here, surprising, the Fed. They don't really say that they have an inflation target, but they do say that they have a measure of inflation that is consistent with stable prices, and that is the PCE around 2%, which is, they in their statements, they call it their long-term target. Most people believe that the Fed has a 2% target, but it never actually says we have an inflation target of 2%, but they target 2%. It's a nuance in the words. It's not really a published inflation target, but everybody who watches the U.S. Central Bank knows that their long-term inflation anchor, we'll call it, instead of, you don't want to call it target, we'll call it an anchor, is a headline PCE of about 2%. Okay, just a note about the Fed's target, well, or their anchor, their 2% anchor mentioned on the previous screen. It's over the long term. That does not mean that they are targeting 2% over, let's say, the next 5 years or the next 10 years, but an average level of inflation of 2% over a long-term horizon, so that if you have inflation of 2.5% this year, they're not going to be too concerned. So they're looking at 2% over a long period of time. So sometimes it might be higher than 2%, sometimes below, sometimes higher, sometimes below. But if they took a long period of time and looked at the average level, they're hoping that it is around 2%. Let's look at monetary policy in developing economies. A lot more challenging to do in terms of price stability. Number one, if we're going to use the tools of open market operations, they simply don't have a big enough or liquid enough government bond market to get that done. And they have a rapidly changing economy, so it makes it difficult to estimate a neutral rate. So a neutral rate is a rate of interest rates such that it neither encourages nor discourages a rate of inflation. So that if you're at 2% inflation and you have a particular interest rate, we will observe that that neither adds inflationary pressure nor reduces inflationary pressure. It is neutral. Well, if you have an economy especially emerging economies, change quite rapidly. They usually have high growth rates because they're starting from such a small base to begin with. It may be difficult to find out where that neutral rate is. They would also probably have no clear or stable definition of money supply. Emerging economies tend to use multiple currencies and multiple other items as currency. So it's hard to measure exactly what the money supply is. Do you measure it in domestic terms? There are lots of emerging countries that have in circulation just as many US dollars as they do their domestic currency, and you can transact in US dollars. The central bank would probably suffer from a lack of credibility as well and a lack of independence. Let's move on to exchange rate targeting. Here, this can be done with either a fixed level or a band. A fixed level is called a peg, where you say we want our currency to trade at par with the US dollar. So $1 of our currency equals $1 US, and the central bank will then buy and sell its own currency in the market to peg it to that level, which is a lot of work. So maybe it might want to have a band. Instead of having it 1 for 1, they may say, well, let's trade in a band of, let's say, 95 cents to $1.05 versus the US dollar. Now it's called the managed exchange rate policy. And the motivation here is by tying a country's domestic currency to that of an economy with a credible policy for price stability, you can import that price stability. So we know that a developed economy will affect its exchange rate by changes in its target interest rate. And if you're a country that is targeting your exchange rate to the US dollar, as the US dollar exchange rate changes because their interest rate keeps changing, you must then buy and sell your currency to target that level of exchange rate, thereby importing the monetary policy from the developed country. So I said that we can import price stability. Let's see how that is done. Let's say that we're a emerging economy and we're pegging our currency to the US dollar, and the US central bank has raised interest rates. And they raise interest rates to lower the level of economic activity so that they can lower inflationary pressure. Let's see how that works in our country. Well, if they raised interest rates, it's going to put upward pressure on the US dollar. And the US dollar is going to increase. Well, we have to then increase the value of our currency because we're pegging the US dollar. So we will sell some of our foreign reserves and we will buy our domestic currency. So our domestic currency will increase. Since we're buying our domestic currency, the central bank is buying it, well, the central bank just throws it in its vault, right? That will reduce the domestic money supply because there's less of the domestic currency in circulation because, well, the central bank bought it up. Well, if you reduce the domestic money supply, there's less money to buy stuff. That reduces inflationary pressure. And as a result, interest rates would adjust upwards. So look at the effect here. The developed economy sets interest rates and the currency will adjust. The developing economy sets their exchange rate to the adjusting exchange rate here, and as a result, interest rates in the economy will adjust. The second term is the more volatile component. So as the developed economy sets rates, you end up with a more volatile currency. Since you're targeting your currency and the interest rates adjust, you will end up having more volatile interest rates in your economy. That is the cost of exchange rate targeting. A term called dollarization. This means that a country simply just adopts the US dollar as its functional currency. It does not have a domestic currency. It just has dollarized its economy, and its currency is the US dollar. Limitations of monetary policy. Let's define some terms. If we have high policy rates, that is referred to as being contractionary. If we have low policy rates, that is referred to as being expansionary. And somewhere in here, we hit our neutral rate. It is the rate that neither increases nor decreases the rate of economic growth, and therefore the rate of inflation, because inflation is just a result of either too little or too much economic growth. Real GDP growth is what we're targeting when we talk about the neutral rate, is real GDP growth, because this is the amount of stuff that is actually produced. The more stuff that's produced, the higher the inflationary pressure. The lower the stuff that's produced, the lower the inflationary pressure. when you see this term pi with the power term E, that pi is inflation and E means expectations. Inflation expectations, so real GDP growth plus inflation expectations in the long run. It targets a real GDP growth rate that results in price stability meaning stable inflation in the long run. Okay, more limitations here. Changes in rates work well for demand shocks, but not for supply shocks. So, for example, if you have a labor shortage, raise interest rates all you want, you're not going to create more supply. So this is the issue facing the United States, the U.S. in 2023, is inflation is elevated, but the participation rate in the labor force is very low because they have demographics that are not very favorable. You have more people retiring per day than are entering the labor force. So the labor force is shrinking over time. The participation rate continues to drop. So you can raise interest rates, but you can't create supply with interest rates. But higher interest rates can deter demand. So if you have excess demand, that works very well. If you have a shortage of supply, you have to destroy healthy demand, not unhealthy demand, but healthy demand. Inverted yield curves. This is where the market lowers long-term yields. So you have a situation where rates rise, short rates are very high, but the curve drops down. So the U.S. has had an inverted yield curve since the middle of 2022. Well, this is where the Fed believes that interest rates should be to slow down inflation. But long-term rates are lower, and mortgages are pegged to, in the U.S., are pegged to the 10-year. So this is sort of working against monetary policy. The more inverted the curve becomes, let's say from the 3-month to the 10-year, that is called a money market to capital market inversion, the 3-month to the 10-year, because the 3-month will reflect the policy rate. The 10-year reflects the market's expectation of future interest rates and future inflation. Well, if the 30-year fixed rate mortgage is tied to the 10-year treasury, which is below the 3-month rate, that kind of works against the Fed trying to have contractionary policy, right? Short rates are greater than long rates, works against contractionary policy. You also have things called curve steepeners. Let's say that the inflation fight is not over. You had an inverted yield curve and the Fed, out of pressure, market pressure or political pressure, starts lowering rates while inflation is still high. What you will get is short rates that are low, but long rates that are high, because the market will believe, well, if you're not going to fight inflation, inflation is really going to be high. And since fixed rate mortgages and longer term loans, like for durable goods, vehicles, car loans are tied to the 5-year, mortgages are tied to the 10-year, well, now they're going to be higher. And we want easy monetary policy to spur economic activity, but because the market believes that inflation is going to be higher in the future, it ends up just pushing up higher rates, thereby working against expansionary policy. So long rates increase, work against expansionary policy. That's why credibility is extremely important for a central bank. A liquidity trap. This means that money is injected into the economy, but it doesn't leave the banking system, because that's how it finds its way in. It finds its way into the system through the banks, which then create credit, which is the money-creating mechanism in the economy. Well, what if banks don't want to lend? Then you get something called a liquidity trap. More money into the system is just held by banks. This is common when deflation is expected. Because if I'm holding $1 today and I think prices are going to be up 10% in a year, it's in my best interest to buy some assets today for $1 because they'll be worth $1.10 in a year. So I'll buy some real assets, primarily real estate or different assets that I can buy today that would only cost me more in the future. But what if there's deflation? So instead of spending $1 today, I can get even more with my $1 in a year from now. That an asset might only cost 90 cents in a year instead of $1. Well, that's the same as making 10% right there. So why don't I just hold off? So your cash becomes more valuable in deflation. So holding cash is better. That is real rates increase rapidly, because real rates are your nominal rate minus inflation. Well, central bank can lower rates all the way to, let's say, zero. Well, if we're in deflation, inflation is negative, so it's minus a negative, which means you're adding your inflation component. That is your real rate. Your real rates increase. Well, better to hold on to cash in situations like that. Plus, loans become risky. With inflation, loans don't increase with inflation. So if incomes increase with inflation and you lend to somebody, let's say you lend them $1,000, and they're going to pay you back in 5 years, and their incomes are increasing with inflation. Well, in 5 years they still owe $1,000. But look at it in terms of the ratio to income. The loan becomes more and more and more affordable simply because the individual's income is rising with inflation. But what if you had deflation and incomes were flat? Well, then the risk of that loan does not decrease over time. It either stays the same or worse. If the person is laid off and the only job they can get is a job at lower and lower rates, their income drops, but their debt level does not. They're becoming more and more unaffordable to pay for. So deflation, the loans they make become riskier, cash becomes more valuable, and that's where you get a liquidity trap where the banks say, I'm not going to lend, it's just going to be riskier, plus I get a great return from cash because real rates are increasing. With deflation, policy rate as a tool of monetary policy becomes limited. If we think about the yield curve looking like this, and there's the zero bound right here. Here are high level of rates. If we think that interest rates are bounded below by zero, then monetary policy becomes limited. If we open our horizons and say, well, what if we had negative interest rates? You can do that. So let's say the yield curve looked like this, where you actually had negative interest rates. This has been tried on bank reserves, to have negative interest rate on bank reserves to avoid a liquidity trap. So if a bank is holding a lot of reserves with the central bank, rather than the central bank not paying any interest on it or paying a small level of interest, the central bank would then charge the bank to have balances. That's a negative interest rate. Well, the bank would then say, well, we're going to lose money just by leaving money at the central bank. We may as well put it somewhere. We may as well lend it somewhere. Typically, it would end up in government bonds, but you really want it to end up in the real economy. If it ends up in government bonds, well, then we can go back to fiscal policy and say, well, if we have deflation, we have to spur aggregate demand. Maybe the government just needs to spend more money if consumers are not going to spend money, but negative interest rates may help. So interest rates would have to be negative. For many economies, that's difficult to do because the plumbing of the system is really not set up for negative interest rates. Remember, deflation increases the real value of debt. It makes debt more relatively expensive versus your revenues or your income. For corporations, if we have deflation, that means the general price level is falling. It means your revenues are falling as well. So if you're selling 1 million units a year at $10 and you have deflation, well, maybe you're only getting $9.50 now or $9. So you'd have to have higher and higher quantities at lower and lower prices just to have the same revenues. If you can't get your quantities up, and if you're having prices dropping, probably your quantities are not increasing. They're either staying the same or dropping, which means profitability is dropping. Makes corporate lending riskier, right? Lower revenues as prices drop, lower incomes, aggregate incomes in the economy as prices drop. Plus, consumers tend to delay big ticket purchases. Now, central banks know something about consumers. They don't, for big ticket purchases, they don't always manage the price, they manage the monthly payment. So what you can do if you have deflation is say, how can we lower the monthly payment on all big ticket items? And there are two big ticket items that really do a good job at leading the economy or helping the economy grow, and that's housing and autos, because they create a lot of employment and they create a lot of supply in terms of just the materials needed to build these things. So if an economy is faced with deflation, a central bank is not out of tools if it gets to the zero rate. It gets to 0%, it doesn't want to go negative, it can do quantitative easing, which means large-scale bond buying. So let's draw out a yield curve. Let's anchor the 1-month rate at almost 0%. We'll keep the front end of the curve, the money market rates low, and we'll just have a curve that looks like this. And what we want to do there's the 5-year and there's the 10-year. Auto loans are tied to the 5-year. Mortgages are tied to the 10-year. Let's get that down. Well, the market's not going to do it on its own. So the central bank could come in and start buying 5-year and 10-year bonds. And when you buy it, you're pushing up the price, which means the yields are coming down. You can flatten that curve all the way out. Lowers long-term rates. You're basically flooding the economy with money at that point. Next learning objective, explain the interaction of monetary and fiscal policy. Okay, interactions between fiscal and monetary policy. Both are intended to influence aggregate demand, but they do so through different channels. Let's make some assumptions and make some statements first before we get on to the interaction. The assumption here is we're going to assume wages and prices are rigid for all of these interactions. With respect to fiscal policy, S meaning spending, spending has a higher impact than tax cuts. And TR meaning transfer payments to the poorest in the economy has twice the effect of transfer payments to all. So if you are sending money into the government's done this before, they write checks to people and they say go spend that as a part of a stimulus program. It is probably better just to target the poorest in the economy, the bottom 30% or 40% of earners, than to give everybody in the economy money. Now, you may argue about the fairness of all that. It's like, well, hang on, if everyone pays into taxes, or if the top 50% of the economy pays the taxes, but whenever we need to spur the economy, the government only gives money to the bottom 50% who do not pay taxes, isn't that a little unfair? If we're thinking about the health of the overall economy, poor people spend almost every penny they make, but wealthy people, if you give them money from the government, probably would just go into savings. So, yeah, there's a little unfairness there, but if we're thinking about the health of the economy as a whole, well, maybe it's a better thing, right? If you also have low interest rates, the effect of both of these, spending and transfer payments to the poorest, is almost twice as much. So let's look at our interactions. And most of these you can use logic to figure out on your own. If I didn't fill this in, you could probably fill these in yourself. Let's go with easy monetary policy and easy fiscal policy. That means our government is involved in infrastructure building and in skills development. A lot of government spending programs to increase the productivity of the economy. Hopefully not spending to just cover expenses, but spending for investment, right? That's what we hope for. This is highly expansionary because both are working on aggregate demand. So aggregate demand increases, rates are low, so both the C and the G component of GDP, consumption, which is private household consumption, and government spending increase. This will, however, encourage inflation. This is an excellent explanation of 2020 and 2021, where rates were super low and the government was flooding the system with money, sending checks to people and spending bills galore. Well, what did we get? You got inflation. Let's move down. Let's keep fiscal policy easy and monetary policy tight, which is 2022, 2023 in the U.S., where the central bank was raising and raising rates, but you had multi-trillion-dollar bills passed by Congress under the guise of Inflation Reduction Act. Let's spend $2 trillion and it will make things cheaper. I don't have the math for that, but, governments, right? So easy fiscal policy, either tax rates are dropping and you leave consumers with more money to spend, or spending increases by the government. Whichever way you do it, G, the component of GDP, will increase. Since rates are high, consumption from private households will decrease, so the ratio of G to GDP will increase. Let's move on to easy monetary policy and tight fiscal policy. Tax rates are increasing or spending is reducing. Rates are kept low, so consumption from households is increasing. Your government spending is decreasing, so the ratio of consumption to GDP is increasing. This is 1995 to 2000 under Clinton, where the government actually had surpluses and was paying down debt. Think about that. They were running budget surpluses and paying down debt, and the economy roared. Because you have less government spending, they need to borrow less. There's less crowding out. So that increased private investment, which increases potential real GDP, and you had the whole internet boom at the end of the 90s. And while that hasn't gone away, and that once we figured out what to do with the internet, massively increased productivity, the amount of investment that went in there. So there is something to say about lowering government spending. Let's go with tight fiscal policy and tight monetary policy. Rates are high. You either have higher taxes or lower spending. Both C and G will decrease. Aggregate demand will decrease. This would be done when inflation is at very high levels. You would do this when inflation is at very low levels, or you are running the risk of deflation. And you would do this when inflation is very high and you're running the risk of runaway inflation expectations.